All right, let me start with on the age model. I tried it in class and knew it was going to be dangerous to do that, but what I did is, well, let me tell you one thing I did wrong on the first one, and I don't know why. I've done this before, but when you do one of these tables, be consistent. You go left to right. I like having the lowest value in the top left and the highest value. I think last class I started with the lowest beta, went to the highest. You want to start with the highest beta and go to the lowest. All right. I don't know why I did that. So you have your lowest value down here and your highest value in the far right corner. All right. And then what I did here is I put all my assumptions in. It took me a while. And one thing that I discovered is there are certain assumptions that give you the exact same numerator. And you don't want that because you have the same value over and over again. So you can see on the short-term growth, I just took it off of 0 and made it like 0.1. So it's slightly different, just like you get different values. And when I do that, it works kind of like it doesn't, because there's so many moving parts, it won't always go lowest to highest. So you can see there's a little bit of out of order, but it's not too bad. I don't know if I would ever put this in a paper, but what I did was get the results of this. And so there's my range, my low, base, and high for the two models. And then my 52-week. Then my upside, I just did my upside of the max of all my values minus my current price over my current price. So my upside is 39%. My downside is the minimum of all my values minus the current price. And then my base is the median of all of those divided by the current. So, you know, it doesn't look too good in this scenario. I don't have as much upside as downside. I did the 20th percentile. So one of the questions you have to ask is when you do this, you can't do this with the table, but you certainly can here. Maybe you take the black numbers out entirely and just see what that does to your valuations. It probably will have some impact, probably gonna hurt it, right? Because these are big numbers. But didn't have that much of an impact, but on the base, it changed the base. But you can't do that to the table. That's one reason I don't like the table. If you decide, well, I want to take the black numbers out, Bill Gates is not gonna let you do it. Y'all can see how you can build your own table, right? You don't need Bill Gates to do it for you. You just anchor everything and copy it across. So that way you can delete what you don't want in there. So, so what you need is, you need scenarios. I am looking for scenarios. We got to figure out how do you make this into a football chart. So we'll do that when someone emails me. So you want to have that somewhere in your paper. And you don't necessarily need the data table in there, though you definitely could do it. If I showed you the C of A's approach, which theirs I think is a little messy, but they just had table after table after table. What if we change our beta? What if we change our short-term growth? What if we change our long-term growth? Here's a table, here's another table, here's another table, rather than putting it all together. So you might say, well, boy, that's really, really messy. But I don't know how many I have here. If you take out, this is always in the wrong spot. So 348, that's probably twice what the CFA had. So I had a lot more scenarios there. At least it's all in one table. With it all being in one table, that's when I can do this type of, you know, the median, the 20th percent, the 80th percent, and get some sense of what the range of my analysis is. All right. There's more than one way to do this, but that gives you some ideas of how you can figure out distributions for your stock. All right, questions on that?
I don't know if you want to
well, take some numbers. It's got to be, it can't be a football table. It has to be a football table specifically related to stock prices. All right, so make sure you have, so if you want to build an example, email me, and whoever emails me first, I'll let them go. I want to know in advance that it's going to happen so I can plan it in this class. So if you can email me right now if you want to be the first to email me. But it can't be a generic football example. It has to be on stock prices in your company. You can make up numbers. You can plug in bogus numbers in there if you want to, but just so you show it. I really want to, boy, I'm seeing those football charts everywhere. They're becoming the norm. So, but
We can do that. Data right there.
yeah, if you want to, you can. All right. So let's get to the final few slides. Well, we actually have quite a bit to do here on relative value. So this is a very, very important chart page. You should know this right here from memory. This is really, really critical. So a PE ratio is measuring the payout divided by a general level of interest rates times the risk of the company times the general level of stock risk minus the growth of the company. So you got two things that are generic: risk-free rate, market risk premium, three things that are specific to the company. We're ignoring the payout ratio because we're assuming that has a direct correlation to growth and that it's a wash, so we don't have to make that adjustment. So we're really coming down to PE ratios are high when interest rates are low. PE ratios are low when interest rates are high. PE ratios are low when market risk is high. PE ratios are high when market risk is low. The VIX right now is at about 15 or 16, which is fairly normal. So we're at a fairly normal level. So why are PE ratios so high right now? Because the risk-free rate is so low. Now, this growth is specific to your company, but you can also talk about the expected growth of overall stocks as well. And that also is going to impact the PE ratio of the stock market itself. If a firm is high risk, what is that going to do to the PE ratio? The higher the beta, the what? Lower the PE ratio, all right? That's why anytime you're doing relative value analysis, you better have some measure of risk, because if you don't, you can say, wow, this is a really cheap stock. It may not be cheap, it may just be risky, right? Risky stocks have low PEs. It doesn't mean the stock's cheap, it just means it's got a high discount rate. Higher the growth rate, the higher the PE. Now you can do this with other things. If you do this with price to book, it gets complicated. I've seen the formula, it gets complicated. You've got to bring in the concept of return on capital and leverage. So it makes the formula much more complex, but it's two things that are specific to your particular stock. So what you're going to have to do with your company is when you get to that terminal growth, you're going to say, when my company gets to a terminal growth, what will its payout be? The typical stock has a 40–50% payout, so you could just assume that. What will interest rates be? What will general market levels? So you might be right now at a level of really exaggerated market risk, but you can say, in 10 years, when my firm hits terminal growth, we're going to be back to normal 15–16% market risk premium. What's my firm's beta going to be? So it is possible the beta you're using today won't be the same beta you assume in 5 years, 10 years. For most people, it is the same. There is a belief that betas tend to trail toward 1 over time. So maybe they would put that in there. So essentially what you're going to do is when you hit your terminal growth, you're going to come up with a PE ratio that reflects your inputs for all of these, for what your normal PE ratio is. I'll show you that when I do Walmart. But that's your ultimate payout relative that you're going to use for your company. So just to give some examples here, I don't know when I pulled these numbers. It's been a few weeks, but Tesla's trading at 1,000 PE, Kroger's at 11, Walmart 29, Amazon 77. These are PE ratio. What's the most expensive stock? Tesla. So $1,000 for $1 earnings. The market must be assuming either Tesla is the lowest risk company in the history of the world, or it's going to be growing incredibly fast. You can probably guess which of those it's assuming. Kroger's, is that an expensive or cheap stock? Cheap. Is it cheap because it's high risk, or is it cheap because it's low growth? My answer is yes, I think so. Kroger's got a lot of debt, and it's competing with Walmart. Kroger's has really struggled. They've tried some stuff, and one thing I thought, boy, that would work for me is, having free daycare in the store. I thought, man, I would go shopping there and I would be taking my time. just to get rid of the kids for an hour or so. But I don't know, those kind of things, that they really drive that much business. And there's an expense to doing that, right? You can't just give the kids to some volunteer off the street. So, it creates risk and all those kind of things and costs. The final thing is price and quality, that they have their own brand names. And we don't know Kroger. I don't know, some of y'all might have grown up with Kroger. We don't see Kroger too much in here. So to me, it's always HEB versus Walmart. That's all I think about. I don't, in San Antonio, what else do we have? No more Albertsons, no more Safeways. Y'all probably have never even heard of Safeway. Food Line's never made it to Texas that I know of. So, Target? Yeah, Target does have groceries. That's true.
I
Yeah.
went to a Kroger in Oxford, Mississippi, a couple months ago, and it was surprisingly nice.
Wasn't it? Yeah. There is a store up in the Northeast. It starts with a W. I can't remember the name of it, but it's not public. But if it goes public, I'll be going. The reason I love it is I was with friends and they're going grocery shopping and we're driving by all these food lines. It's like there's one. I said, no, we're going to this store. And they drove like 30 minutes to go grocery shopping. And we go in and there's these high school kids on dates in the grocery store at the little restaurant there. They sell. It was pretty amazing. I don't know how, because everything I looked at is like, okay, their prices are normal, but everything I'm looking at is like, there's an expense, there's an expense, there's an expense. Either they have really bad margins or they got some trick. They even had covered parking in a parking garage, and it was like, all right, so maybe they're just not very profitable, but they just love what they're doing. I don't know. But anyway, Kroger's gonna have a tough time with growth because they have really tough competition and they got a lot of debt. So is that a cheap stock? Maybe not. Walmart looks expensive, but this is a low risk company. So if Walmart expensive or they low risk, we don't think of Walmart as a high growth company, definitely, but they are very low risk, a low beta. We saw that, right? We're trying to argue how low can beta go on Walmart. They have definitely proven themselves, so maybe they're not that expensive. Amazon, we don't think of them as low risk, but definitely high growth. So you've got to adjust whatever you do with relative value analysis. You have to have something related to fundamentals, something related to risk. If you don't, you're going to make a huge mistake to a company. So your numerators, you have two choices: price or enterprise value. And your denominators, you have many choices, but they're related to earnings, book value, or revenue. Now you can do other things. So like with Tesla, I did enterprise value to number of cars sold. I just want to see, and they're just off the charts versus other auto manufacturers. And then I did Tesla's valuation if they were to sell every car in the world, and they were still expensive. Okay, so here's a stock they need to get 100% market share just to be a normally valued company. I think that sounds like a pretty tall order. So you don't have to use these three, but these are the ones you're going to select from because they're available out there. What you got to know is when to use price and when to use enterprise value. I think it's pretty simple, but I've had students really struggle with it. So the key is the numerator and the denominator need to be matched based on how debt and stockholders are aligned. So on earnings, some of these earnings are after interest expense, some of them are before interest expense. How can you tell it's before interest expense? Any guesses? Before interest. So I hear students say earnings before income tax. That's not what IBIT is. What is IBIT? Earnings before interest and taxes. Okay, that's not income tax. So IBIT is before interest. If it's before interest, that belongs to stockholders and bondholders. So what do you use? Price or enterprise value? Enterprise value. Anything that is before interest expense has to use enterprise value. If it's net of interest expense, it only belongs to the stockholders, and that's when you use price. All right. So earnings per share, is that before or after interest expense? That's after, so you use price to earnings. All right. What about cash from operations? Price to cash from operations or enterprise value cash from operations? It's price. Now it shouldn't be price, it should be enterprise value, but here's where accountants made a mistake. What mistake? Remember what mistake did accountants make on CFO? Where should interest expense be on my cash flow statement?
Investing activity.
Not investing, but you're closer. Under financing activities, where do the accountants put interest expense? On the cash from operations. So yeah, you can do price to CFO because interest expense is in the wrong spot. So that one does work. You got to be careful sometimes, like with real estate, you know, Jabari real estate, you usually use FFO, funds from operations. I think that's for interest expense, but always double check because I'm not a real estate person. So real estate's almost always price or enterprise value to FFO, but you got to check and see which one. That's one where Bloomberg would probably tell you. You look and see which one Bloomberg has because they won't have the wrong one. All right, book value, is that gross or net of interest expense? Net worth of the firm. Do they add back interest expense when they get the net worth of the firm? No, it's net, right? So it's gonna be price to book. It's not gonna be price, enterprise value to book. That wouldn't make sense. Revenue, is that net of interest expense or before interest expense? It's before, right? Interest expense is way down on the balance sheet for an income statement. So you use enterprise value to revenue. Now I realize Yahoo Finance has an error there. It's one of the few errors, but they have both price to sales and enterprise, and they even changed the term price to sales and enterprise value to revenues. So I don't even know why they make that adjustment. But you definitely don't want to use price to sales. If you use price to sales and the firm has enormous amount of debt, they're gonna look really, really cheap, but you have all this interest expense that you're not accounting for. If they got a lot of debt and you use enterprise value, you're adding all that debt back, so they don't look so cheap, right? Your numerator is going to add, so they have like humongous, like Kroger's. So they have a humongous amount of debt, and you do price to sales, they can look incredibly cheap because all that debt's being ignored. It's not in the price, it's not in the sales, but use enterprise value, the revenue, then you add all that debt back to enterprise value. It's in your numerator, you get a much bigger number, then you're doing the right kind of analysis. Okay. So I don't know why they have this one there. I don't know why they changed between the word sales and revenue, but enterprise value is the one that you want to use when you use sales. All right, so that's the key. Then the question is, which one do you use for your company? So here's the ones that work: price to earnings, which is the most common one, EV to EBIT, EV to EBITDA. We'll talk about the PEG ratio, price to book. And one I do like that works really well, this is the Robert Schiller one, is if a firm that's very volatile, their earnings are just, you know, like a commodity driven firm where the commodity's high, they look really cheap. When the commodity's low, they look really expensive. What you can do is do it over multiple years of earnings to try to get that spread out, which is similar to price to book, except for price to book, if they're buying stock back or paying dividends, that's going to mess with your book value. And you have some firms whose book values actually go negative because they bought so much stock back. But price to multiple years earnings per share, that gives you a positive number that you can do the analysis with. So I don't know if y'all familiar with Robert Schiller, but that's what he does. He does price over earnings, but he does price over 10 years of earnings, but he takes inflation out. So he does inflation adjusted earnings per share. And then revenue based, EV to sales, or EV to revenue, whatever you want to call it. Right, so those are your choices, but you have others like enterprise value to FFO. So there are other ones. When I was looking at what USA got paid for its investment arm, I looked at EV to assets under management. That's a really good one to use. That's kind of like a price to book, or EV to book, except for asset under management or before interest expense. I just was curious if they got a good deal. All right, so here's the choices. Earnings base for those where you're really focused on growth, those high growth companies like technology or pharmaceutical or biopharma. We tend to use earnings base. EV to EBITDA is one of the most famous ones out there. Everybody loves EV to EBITDA. Dr. Demedaran says it's because we like saying EV to EBITDA, whether that's the case or not. One of the advantages of EV to EBITDA, if you're doing a model, is you're adding so much back to earnings. You're adding back interest, taxes, depreciation, amortization. It gives you much fewer negative numbers, so you don't get as many NAs, so it's kind of nice. Price to earnings, you can't get a price to earnings if earnings is negative. So you get a lot more NAs and you have to kick out a lot more firms. So if you got a nice EBITDA that you can use, an EV to EBITDA is a really, really good one to use. I didn't mention the PEG ratio here, but the PEG ratio, we talked about it. We're going to talk about it when we talk about growth. Or we did talk about it when we talked about growth. PEG ratio is very, very popular with tech stocks. So you might try PEG ratio. One of the issues with PEG ratios is you do get a lot of NAs. So if you got 200 companies, you may have to kick 50 of them out because they don't have a PEG. They may not have a PEG because they don't have a PE. They may not have a PEG because they don't have forecast earnings. Either way, they get kicked out. So a lot of firms get kicked out with a PEG. One thing we tried with our tech group, and Fernando's down here, but Jason, who spoke to this class several years ago, he had what he called a historical PEG ratio. So the traditional PEG ratio is either the PE over expected earnings growth, but he said he likes to do a PE over historical earnings growth, and to try to get something that's, you know, not relying on somebody else's forecast, just to see what is the market paying for historical growth, and that's easy to calculate. You can get that number. So if you're in technology or anything that's considered innovative out there, you know, communication services, Facebook, Google, those type of firms, EV to EBITDA is the most likely thing for you to use. Book value is utilities, manufacturing, those heavy, you know, if I was doing Intel, I would probably do EV to EBITDA and price to book for Intel. I'd probably do both because Intel has heavy property, plant, and equipment. So Javier, for yours, price to book is going to be most obvious. In utilities, you almost always use price to book. Also, as I mentioned, cyclical companies use price to book or earnings to multiple years of earnings per share because they're very, very cyclical. Price to book is very, very popular with emerging market stocks because they're so cyclical and so commodity driven. And in industries that are focused on return on invested capital, banks, insurance companies always use price to book. So if USAA decided to sell their bank, they would probably go to Cap One, look at Cap One's price to book, which right now is about 1 to 1. And they would value that against their bank. And that's probably the way to do it, price to book. It's the most obvious thing to use for banks. And then for retail, we usually use revenue base, EV to revenue. Where margins rule, we use EV base. But I mean, EV to revenue base. However, be really careful anytime you're doing an analysis. When you have EV to revenue, you always have to have gross margins in your analysis. Otherwise, Walmart looks really cheap, right? Because Walmart has massive revenues, and Tiffany's looks real expensive because they don't have that big of revenues, but then you adjust it for gross margin, and Walmart doesn't look all that cheap, and Tiffany doesn't look all that expensive. In fact, one thing you could do, I haven't seen many, I don't even know if Bloomberg does this, is instead of doing EV to revenue, do EV to gross margin. And that I think can be, you know, think about it, a good example. I mean, for Valero, what would you use for Valero? Just based on what we said here. Probably book value based, right? But for Valero, EV to revenue would be really, really dangerous because gas prices go up, prices go down, but gas prices go up and down with oil prices. So if I were going to use an EV for revenue for Valero, I would definitely switch that to EV to gross margin. That way, oil and gas prices, as they move together, my gross margin is much more stable. I've got a good. Same thing with, oh, I forgot the name. I never remember the name of the steel company. The one, anyway, but it's still a company where most of their input is refurbished steel, you know, secondhand product. Their input is very sensitive to steel prices. Their revenue is very sensitive. Gross margin is going to make more sense. So I would say use book value, or if you're going to use this site, and then I need to look on Bloomberg. I'll try to do that tomorrow and see if they have an EV to gross margin. That would be really cool. I've never seen it in an official report. You know, I think it exists. EV to gross profit. That's not the same thing, I don't think, but it could be. Gross profit. Yeah, I think gross project profit is gross margin is what they mean here. why EV the revenue is the wrong way to value companies. Well, we're not valuing companies, are we? We're looking to see if they're expensive or cheap. So I'm not sure if the even question makes sense. All right, but anyway, just be careful with really volatile firms where they're very commodity based. Be really careful because firms that are commodity based look really cheap when their commodities high in price. They look real expensive when their commodities cheap in price. And yet that's probably the time you want to sell them up here, probably the time you want to buy them down here, right? If you bought all these energy companies back when oil prices hit that floor, they would have all looked really expensive, but it would have been the perfect time to buy them because their earnings were down because the commodity was down. Questions on this? Now, I'll show you what I actually do in models is I like to bring them all in and just let the model decide where to allocate it, because I've noticed with tech companies, even though it makes more sense to use EV to EBITDA, a lot of times the models prefer EV to revenue. And the model prefers it, let the model allocate to it and tell you what's going on. So what can you do relative value for? I'll show you with the screening. You could, some of you are taking John Tui's class next semester. You could set up a model like I'm going to show you for bonds. And then you're trying to justify their option adjusted spreads and see if you're getting enough by adjusting for these other things. There you're going to be very, very focused, obviously, on risk type of measures. But try to see, hey, is this bond well valued? Value non-publicly traded companies. So like I said with USAA, it would be, I don't know what USA's banks net worth is, but Capital One, their price to book right at 1. Tomorrow night, I get to do my first sweet spot for the investment side, or the second one this semester, because I've been cheating and having outside speakers. But I'm going to talk to them about when finance majors should gasp, when you see a number that should really bother you. And if you don't know, then you haven't gotten enough experience. This is somewhat of a gasping number. Most of my career, until the 2008 crisis, banks always traded at a 2-to-1 ratio. It's just the norm. Banks, you just thought bank price to book, oh yeah, 2-to-1. And then they just dropped dramatically. And we're talking, well, Genworth is still down there. I think Genworth is a pretty incredible one. Now, you're having financial institutions trading at a price to book of 0.15. Now, what did you learn in accounting? Accounting is supposed to be what? Conservative. And yet the accountants think Genworth is worth 5, 6 times more, 6, 7 times more than the stock market. That shouldn't be there, right? You get to pay 15 cents for $1 net worth for Genworth. That's a really cheap stock. But financials, insurance companies, banks have traditionally traded for a 2-to-1. Now, JP Morgan's getting back up there. I don't think they're quite back to 2 yet, but they're getting back up there. And you say, wow, they look kind of expensive. Well, no, in my whole career, I would have seen that and say, yeah, they're pretty normally. But today you look at it and say, wow, they look real expensive. So try to get a historical perspective on these type of companies. Citibank's still well below 1. I mean, that should seem unusual to you. Stocks shouldn't trade at a price to book below 1 if accounting really is conservative. That just doesn't make sense. I mean, what is it? You can buy this bank for less than what the accountants say. What asset or liability do they have that's grossly mispriced? Interest rates are low, right? What should that do for their assets and liabilities? It should raise them both about the same. I don't know, what are we missing? Did they have some really bad debt that we're not accounting for? What is it? That seems too good to be true. I'm not saying go buy Citibank, but what is the market telling us with these type of valuations? It's really, really quite unusual. And that's a big difference between JP Morgan and Citi, isn't there? 1.95 versus 0.73, that makes a big difference. And the more investment bank types, kind of in between 141. You could see Goldman Sachs and Morgan Stanley trading like 2.5, 3 during most of my career. So that still seems pretty cheap. So JP Morgan's about the only normal one out there right now. I don't call them flossed. I would guess they're well below 2. No, look at there's Colin Frost, the one normal bank out there. They've come up quite a bit the last few years. Now, Cullen Frost is a huge takeover candidate because their deposit to loan ratio is off the books. They have a massive deposit base with very low loan base, and that's what banks want. I don't know if Frost ever wants to sell out, but they would be bought very quickly. But I don't know who would buy them, but their deposit base is what they want, especially when you don't have a big loan book to have to worry about. I mean, Goldman Sachs would be the perfect one, right? What's Goldman Sachs trying to do? They're trying to become a bank. They could buy all these deposits like just overnight. All right. So value non-publicly traded companies, you see what the market's trading for. You probably bring in, it's tough with USA's bank. USA's banks doesn't look like JP Morgan, doesn't look like Bank of America. So it's not a community bank. It's not a regional bank. It's a national bank, but very specialized kind of niche. It is probably still more credit card than anything else. And that's why I compare it against Capital One. But it's hard to really find a perfect comparison. But you bring in maybe 5, 10, 15 banks that you think are similar to them and look at their price to books, and you're going to try to get it. USA would try to sell it on the higher end. Whoever's going to buy them try to get it on the lower end, and that's the debate you would have. So yeah, this is probably, if you work for a investment bank, you would just have these numbers on top of your head. Someone says, hey, we got this social media company. Oh yeah, they should be trading at 4.71. You just know, or whatever, 18-to-1 EV. Who knows? What's Facebook trading for right now? So what would we use for Facebook? What's the best ratio for Facebook? High growing tech company. EBITDA, right? There it is, 16.5. So why do people, this is, I think, Damodaran meant, I love his cynicism. Why else do people love EV to EBITDA? Well, it's going to give you the lowest number, right? Price to earnings is give you the highest number because you have the lowest earnings. And you have price. EV, you have net worth, you have market price plus debt, and your EBITDA is the highest number, so you get the lowest valuation. A 16.5 EV to EBITDA is a very high number. It doesn't sound high though, does it? Because you're used to PE ratios, in the 20s and 30s. Oh, I got the wrong company. Oh, it is. Oh, I was going to say the wrong company, but I don't. I don't know why this current is so low. That's really strange. So these are ridiculous EV to EBITDAs. Yeah, this does actually, these numbers don't make sense. So let me find a more normal company. Let's do Microsoft. No, I can never get Microsoft. There's another company real similar. All right, so EV to EBITDA. Yeah, I don't know what this current means. There's something. Is there a Yahoo Finance error going on here? These numbers don't make sense whatsoever. It's almost like they're taking EV to quarterly EBITDA, which would be completely ridiculous. So I think there's actually, this is good. Thanks. I think I think Yahoo Finance has an error. So let's go annual and see if that fixes it. Oh, don't lock it. Require access. Oh my word. Okay. Okay, well, forget all that. So Yahoo Finance is like no longer use our services. But so you have to adjust your thinking. But what Damodaran says is, you go to talk to your boss and you want to buy this stock, and their PE ratio is 28, and their EV to EBITDA is 17. Which number do you want to give to your boss? The 17, but your boss should be making that adjustment, but they it's hard to do that on the fly. So 17, that sounds reasonable. The stock market's at 20 something. So no, it's a little bit of distortion. Benchmarks for companies, you can certainly do that if you compare firms with similar price to earnings and what their gross margins are, what their revenue growth are, and try to figure out, why is this company trading at a 20 when this one's trading at 26? What is it that distinguishes them? And then you can also tell what's most important to the stock market. Which factors do you need to be able to best predict what the PE ratio for a firm will be? So there's two approaches. Dr. Demerdarin in his classes uses a regression analysis approach. Some of my videos, I do regression. I don't like regression analysis anymore because, in my opinion, if the regression gives you a great regression, but the slopes are wrong, you have to throw it out. So if your model has a positive slope on debt, telling you firms with more debt are more valuable than firms with less debt, you might have a great R squared of 92%. But do you really want to pay more for high debt rating companies than low debt rating? It doesn't make any sense. Or you have firms with low asset turnovers are valued more highly than firms with high asset turnovers. That doesn't make sense. So I'll show you a ranking model so you can see how that works. So here's what I said in the previous class. You build your own ranking model, you get a 10% bonus. If you want me to build it, I will. I've already built one here. If you want me to build it, you can use this model. And then, you don't get the 10% bonus, but at least you get the paper written, okay? So what did I do here? I got the companies y'all picked, and I threw Walmart in there. So there's your companies. And so what I did is I said, I want something related to turnover and working capital. And I forced it to give me at least 10% there. I have measures related to margins. I wanted at least 25% there, but gave me 63%. That makes sense for retail, that margins were going to be king there. I wanted something on return on capital. I would have liked that to have been higher, but I forced it up to 5%. And then I wanted, something on risk, definitely. So I've got the different categories. I forced it to do more. The original model did everything, the margins and risk, and then nothing on turnover. I don't see how you can ignore turnover for retail. That's got to be important, especially working capital. So I forced those in. And so here's my turnover, obviously asset turnover. Now, why didn't I use something like inventory turnover? Well, that's really, really important. The problem is not all of these firms have inventories. So if I've got a hotel, hotels have inventories, but is that what you care about with a hotel? I'm sure they have some soap and towels and that kind of thing, but that's not what that's not what they do. They're a service-oriented firm. So if you do an inventory turnover, you're gonna have to kick out a lot of companies if you do that. So I just did asset turnover, and then I looked at the change in asset turnover. Where was their asset turnover 3 years ago? Where is it today? The negative numbers means it's getting worse. Positive number means it's getting better. You can see most of them are actually getting worse, quite a bit. I did 3 years sales growth. That's a turnover. Remember the first thing you talked about under turnover on paper 3 was the growth in revenues. So I did that. I have working capital, the sales, so there's my working capital, and then I did the change in working capital. Here I wanted it to come down, right? If you had higher working capital, the lower working capital, that's good. I wanted the firms that had actually reduced. You can see it's pretty mixed all the way throughout. Gross margin and the change in gross margin, you notice gross margin has been really decimated from most companies. So there's the end of my turnover. I'm sorry, gross margin was my margin. So there's the end of my turnover. So I have 5 things on turnover. What else could we add on turnover? So it depends on your entity. I could have done inventory turnover and just kick out all the companies that have inventory. Say, hey, my firm has inventory. I don't want to compare them against firms that don't have inventory. Okay, that's fine. I could have looked at revenue per square foot, and then I have some firms that don't have square feet, so I'll just kick them out because I don't want firms that don't have stores. So you can do your own type of kicking out of firms. So anything you did in paper 3 under turnover, I could do revenue to property, plant, and equipment. I could do revenue to regulatory assets. I could do revenue per store. There's all those things we talked about under paper 3. You can try it here. If they don't have a Bloomberg number, let's say you want to do revenue per store, then just bring in revenue, bring in number of stores, and calculate your own, and you've got your number. So you can do it yourself. Revenue per employee, the same way. You can do that ratio and look at it as well. All right. Then I have my margin numbers, my gross margin, my change in gross margin, my net margin, my change my net margin. I brought in profit margin and they said they normalize it. I don't know exactly what Bloomberg is doing to normalize that. The reason I do that is profit margin is often focused on more than EBITDA margin, even though I don't think there's a huge difference in those two. And then I did change, and I did the EVA spread. Remember EVA from your 3013 class, it's return on capital minus the cost of capital. So I want that number. And then I did the change in EVA, which I actually think is more important than EVA itself. I brought WACC in. So there's all my return on capital. So I got my margins. We got my return on capital. The only return on capital I have is EVA spread or EVA. Oh, no, I didn't. Excuse me. WACC is in the wrong spot. Sorry about that. WACC should be under risk. So there's my return on capital. And then I use the Bloomberg function, which is their estimate of the risk of a firm. So essentially they've got everything in one number. So I love that as a measure. And then I brought in two things, EV to EBITDA and EV to sales. I'm assuming the model is going to allocate 100% to EV to sales. At least I have it in there. So I've got all my data. I combine consumer discretionary and consumer staples, just so I didn't have to build two different models for y'all. So I've already got the model built for retail. So if you're retail, you can use this model if you don't want the 10% bonus. And then I just rank them. How does Best Buy rank on asset turnover? Well, they rank very high on asset turnover. I've got 288 companies and they're number 8 on asset turnover. Costco is number 6. We know that, right? Because your charts, they're always at the top of the chart. So Best Buy ranks really, really high on asset turnover. That's pretty impressive. They got a lot of stores, fairly expensive stores. They don't have the warehouses like Walmart, so that might be what hurts Walmart. But Walmart scores pretty well on that as well, 17. But their change in turnover is not that great. They're kind of in the middle of the pack on change. So they got good turnover. Same thing with Costco, right? They got good turnover. Costco's turnover is just the same all the time, so they don't improve any. Sales growth, they're not all that strong on that, 1/20th. None of your companies is particularly strong on sales growth. Target's in there. Lululemon, good sales growth there. Working capital. Procter & Gamble does really well on that and does really well on the change in working capital. I'm sorry, I got someone in the chat. All right, someone was asking the question, how do you define this sector? I've seen all different ways. I tend to, if I build a model for you, I'm going to the sector level. I'm just gonna have a bunch of companies in there. For airlines, if I did airlines, I would always just do airlines. But if I did airlines, I don't think anyone here is doing airlines. I don't think. But if I did airlines, I would only do airlines and I would bring in non-US airlines. So I could have more companies. So you can usually get 13 to 15 of them. For technology, as Fernando's out here, but on technology, what we have to do is we bring in all technology and then we kick out all the semiconductors because they always mess the model up. Healthcare, I would probably, someone's doing Abbott, I would probably in healthcare separate the equipment from the services. And I would kick all the pharma out. If I was doing pharma, I had pharma all by itself. So it just depends. But the thing you can do with this model is once you have the model built, you can bring in sector, sub-industry sector, you can sort it, and then just take out a group of them and see if it affects your model. Right? We were doing that with y'all's models, right? Just say, hey, what if we take out all of the hotels? How does that affect my model? It's like, oh, wow, that really helps the model a lot. Hotels really don't fit in here, and you just take them all out. And you know, so there's different things you can do. It's entirely up to you. You have to decide how you want to scale this. But I usually start at the sector level just to see, would you get a better model if you only did restaurants? Maybe. What's the nice thing about only doing restaurants? Well, then you can look at revenue per store. then your gross margins make more sense because you're comparing apples and apples kind of thing, no pun intended. So, would you only do apparel stores? Well, that gets a little tricky. Some apparel make clothing, some apparel sell other people's clothing. You know, does Nike have revenue per store? I think they do, but how many stores do they have? Not very many. You know, so it's kind of tricky. So you got to be careful. Even restaurants, there's a huge difference between a McDonald's that's mainly franchised and boy, I can't think Sonic. I think Sonic owns all their own company, their stores. A franchise versus a non-franchise, you can get radically different answers. The asset turnovers look great for franchises, but you know it's a different business model. So you know you have to be careful when you're comparing these. I usually think the more companies you have, the better. I'll just give you a good picture of what's going on, unless it's a really specific industry, like airlines. Industrials tend to do pretty well as a major group. Materials, Ecolabs, who was the Ecolabs? Yeah, David, Ecolabs, I tend to separate the chemicals from the metals. Just makes more sense to do that. Jabari already has his model built because he's been building it. We struggle, but you finally got a decent model now to work with. We had to kick out the outliers. We had to, you know, debate. There's a lot of people converting to REITs, like American Tower. What was the one we saw? It was so strange. I can't remember. Did you have Americold?
Yeah.
Yeah, that Americold. That was like a really, why are they in REITs? I mean, they warehouse cold food. That's not a real estate company. That's kind of an industrial company. So, you know, to ask the question, why do you leave in, why do you leave out? So he's already got his model built, so he's in good shape. But we discovered that his company was the real one because he's got a broker. He doesn't have a firm that actually owns real estate. He's like, wow, I wish I picked another company. You know, kind of, but so, you know, you look at it and you say, I'll take these out, leave them together. You've got to make that decision. It gets real tricky on financials. You say, I want to do life insurance companies. Well, good luck with that because there are a lot of life insurance companies that also sell property and casualty. It's really hard just to do one company. There's a lot of life insurance companies that also do a lot of asset management. So do you put BlackRock in there or not? It's really, really tough. Banks are really tough. What we figured out on banks, and y'all aren't doing these, so I'm just telling you some things we've learned. Bank models don't work well unless you separate the big banks from the small banks. So any bank over $15, $20 billion, you put them in one group, all the other banks, you put another group, and then you get a decent looking model. So there's no rules on this. You just figure out what belongs together. All right, so we rank them using the rank function. The rank function, you take their asset turnover first company compared to all the others. So Best Buy is 8 out of there. So you can see on working capital, you notice I do comma 1 because when you use comma 1, it means a high number is bad, a low number is good. For sales growth, I use comma 0 because a high number is good, a low number is bad. So you got to be careful on that. Change in working capital, comma 1 again. I want that as low as possible. Gross margin, comma 0. Change in gross margin, net margin. WACC, I did comma 1 because WACC is your cost of capital. Higher cost of capital means riskier. I just got it in the wrong spot. I should put it over with risk. So I just messed that up. It didn't allocate anything into it. Anyway. Return on capital, change in return on capital, and then, you know, obviously your probability of default, higher is bad, so comma 1 on that. So I've got everything ranked, but you see Best Buy ranks really well on some things, ranks kind of above average on some things, ranks really, really badly on some things. You would have thought Best Buy would rank really well on gross margin. They don't, they rank near the bottom. It's kind of strange. They even rank worse than Walmart. That doesn't make sense, but again, that cost of goods sold, who knows what they're sticking in that number. So they rank good on profit margin. They work really well on EVA, but they don't work well on change in EVA. They have a high cost of capital, but they have a really good return on capital all the way across. So we're going to see if we can take all of these factors, and we've got a bunch of them here. And we take all of these factors, 17 of them, and try to predict their EV to EBITDA or EV to sales. Okay. So what I do is I just take all of those factors and I just weight them by some weight. And so Best Buy's average weight ranking is 153.17. Now, is that good or bad? You really can't tell. The one right before it's Chipotle's right with it. So Chipotle, but for very different reasons. They're all over the place, right? And then I do it on valuation. Well, notice what the model allocated to on valuation. 100% EV to sales. I kind of knew that was going to happen, but I have it there. So my value rank and my fundamental rank. And what I do is I'll re-rank the fundamentals. Because here's the company, Philip Morris. So who's saying Philip Morris? Is that you, Aaron? Or wait, someone here? Oh, Anthony. So Anthony, your firm, in my model, your firm is the #1 company. But it's not #1 on anything. It's #2 there. So how can they be the #1 company if they don't rank #1? The only way their weighted rank could be #1 is if they were actually #1 all the way across. But they're 24 weighted rank. That's a really good number. And so that's actually the highest overall. That's the best rank. But they're the 17th most expensive. So you have the company you think's the best. Well, the market thinks it's pretty good too. So that difference is only 16. Right? So if you look at the chart, this is the chart that you're trying to create. So can y'all find, so the cheap stocks are down here. So Philip Morris is down here somewhere. Well, they're right there. I don't know why they're right there. So 8 and 6. That doesn't make sense. Philip Morris. Let me find them just real quick. Here's how I find a company, just FYI. See if it moves. Y'all see it move? There it is. 1 and 117. Let's see it move back down. 1 and 17. It's right, but it doesn't look, it should be below the line. I don't know why it's above. Do I have my numbers backwards? Let's look at it. So the 1 is where you rank it, the 17 is where we rank it. So maybe I flip my charts. Maybe these are the cheap and these are the expensive. So be real careful on that. Wait, that sure doesn't look like 1 in these, so that's kind of a frustration with that. Let me find an obvious one. So Walmart, let's look at Walmart. Walmart is 135 versus 221, so that sounds cheap, doesn't it? So I do think I've got it switched to, so that's just easy to fix. Unless Bill Gates jumps in and does that. So Walmart is, we rank it 135th right here, but it's actually the 221st. So here's the valuation. So the higher up you go, the cheaper you are. The lower you go, the more expensive you are. The further right you go, the worse the company. So the best company all would be right here, right? We rank it #1 is the cheapest company out there. Would you buy that company? You probably say, wait, something's going on here. What are we missing? That would be pretty crazy, wouldn't it? So, so that doesn't exist, but here's a company. We rank it 109th, and it's actually the 263rd most expensive. So Philip Morris is cheap. We rank it first. The market ranks at 17th, but it's not radically cheap. Of all of our companies, what I don't like about Walmart is, yeah, they're cheap, but they're mediocre quality. So I usually will look for companies around in here. I want firms that I rank high that are cheap. So I like this. So whatever these firms in right here, this one right here, 36, that's a pretty good ranking in the top 4th. And they're like middle valuation. That sounds pretty good to me. This firm up here, I rank it 109th, which is to me a kind of a low quality company, and it's cheap, but I prefer high quality that are cheap. So that's just my opinion. But anyway, you got your company in there, you got where it fits in on the line. Make sure you got the cheap and expensive in the right places. So that's what you're after. You're trying to get your model set up. If you want to build your own to get the 10% value, we have videos on my YouTube channel that walks you through that. Just make sure you pick one that's a ranking model and not one that's a regression model one, because it won't quite work. Over here on the right, this is where I bring in the values I want to do the change. So here I want to compare these two asset turnovers. And what I did here is I put a function in, and you'll see it. I like to do this. It's a function that just says, give me 2021, but if that's an error, give me 2020. And so it just does that all the way across. So if I can get 2021, I compare 2021 to 2018. If I can't, I compare 2020 to 2017. So that's all that formula. It looks like a complicated formula, but it's really not all that complicated. So that's what I do, and then I just compare them. Why do I do this over on the right? Well, I want to make sure whatever I'm ranking is all nice and in order, so that my ranks I can just copy across. I don't have to edit so much. And so it just makes it a whole lot easier for spreadsheet purposes. But we love to do this in the investment society. I love these type of charts. And just real quickly, it just shows you what you think. So Costco doesn't do too well over here. Not that your model, you built your model already too, right? Where did Costco rank on your model? Did it look expensive?
It wasn't that good. It wasn't anywhere near the top.
Yeah, so it's Best Buy looks really good. A mediocre company, but trading really cheap. Target looks really strong. Target's definitely one you might put on your list to buy. Columbia, I forgot who's doing Columbia, but Columbia looks pretty decent. Procter and Gamble, Philip Morris, they look good. They don't look particularly cheap. Nike looks okay. It's right on the line. Most of the companies you picked are like really good companies, but are expensive. And that's kind of we expect. Our worst company, who is this? Is that you, Alejandra? Who picked Wing or Beat? Is that Greece? Who are you? Best Buy. Okay, so you got decent. Who was Wingstop? Is that you, Greece? Okay, so yeah, Wingstop looks horrible, but you know, you could run a model and get something completely different. I mean, that's the thing.
How do we let this graph affect on our buying self?
Well, you wouldn't be marking all the competitors because you don't care about these companies, but you might mark 2 or 3 key competitors. And then your discussion is, the model didn't like my company. And then you go back and you look and just see why. So why doesn't it like Costco? So you go through and you say, okay, let's look at the things that it did put into the model. So it ranked 6th on turnover, but my weight on turnover was 0. I forced 5% in on change, but they didn't rank all that well on that. Their sales growth, they ranked fairly well there. I only put 2% of my weight there. You can tell when I manipulated the weight, here's what Solver solved, and I added 2% there. So you can see that. So they didn't do well on working capital. And I put here's the key right here, the gross margin, which you expect. They have a horrible gross margin by design, and that's 30% of my weight. All right, so that kind of makes sense. But then they should have a really, really low EV to sales. So the fact that they rank poorly in gross margin is okay because they look really cheap on EV to sales. So that's kind of the offsetting factor. Their EBITDA margin, they rank really low there, and that's a really big weight for me. So why is Costco, the model isn't like Costco? Because they have such thin margins. Now, what isn't my model picking up? So if I were doing Costco, what's the one thing you might add on Costco I don't have in here? Bring in 5-6 years of gross margins and do a standard deviation margin and add that into your model. Then they're going to rank really high on that, but then your model may not like that, right? It doesn't have to keep us Costco. They're so predictable. So the fact that they're razor thin, you're okay. You know, you don't usually like razor thin because it means they're going to lose a lot of money. But if they're razor thin, but they're always razor thin, the exact same number, then that offsets that. But you don't have that in the model anymore.
Sounds like no matter what model, I mean, most models are like Costco.
Well, unless you did the volatility and it put 20% in there, then it probably would bring that in. But that would be a discussion in your paper is like, I built this model and I think the model works well for a lot of companies. I think it actually misses it on Costco because it doesn't have anything about the consistency. On the 5-year default, they rank really, really well there. That is a high rate, so that does help them some. And they're not as cheap as you would think on EV to sales. I'm actually kind of surprised. That's a pretty surprising number. It looks like Costco is trading rich. It really does. A 163 EV to sales, they should be like one of the cheapest. I don't know why Walmart, yeah, these numbers are.
Where's Walmart in the graph compared to Costco?
Walmart
Very
looks
similar
cheap.
numbers.
Way cheaper.
Walmart looks cheap.
Overall.
Yeah.
I think Costco PE was like 40 and Walmart was like 30.
Yeah, Costco looks expensive. I'm kind of surprised on these asset turnover, asset to sales numbers. I mean, revenue sales numbers. Walmart's is really, really low. What? Oh, I'm sorry, I said it backwards. So Walmart's really cheap. That's right, I said it backwards, sorry. So Costco's trading cheap, but not nearly as cheap as Walmart. So yeah, I think that's the issue. Sorry, I said it backwards. So 163 means they're really cheap, not they're really expensive.
Then why are they expensive?
Well, because their margins are so thin. They should be, their margins are much thinner than Walmart's, and yet they're trading much more expensive than Walmart. So it's their margins. Yeah, you can look at the numbers and see it's definitely their margins. If they had Walmart's margins, they would still be expensive because they're so much more expensive than Walmart. But they have much worse margins than Walmart, and yet they're trading at a higher EV to sales than Walmart. That doesn't make sense.
Would you weight all of the requirements differently from Walmart and Target or Costco and Walmart?
I don't think you can change your weights between companies. That would be kind of tough.
Well,
to
would you
do.
split differently? Instead of 30,
Well, this is where I put my own weights in. So here I came across and it said, it put nothing in turnover. And said, well, I'm going to put something at asset turnover. I'm going to put something in sales growth. I'm going to put something in working capital. I got to have something there. So I just added those in. Now I added 10%. So that means I got to do what? I got to subtract 10% out somewhere else. So I just kind of took the biggest numbers
Could
and
you do
subtracted.
the graph with the solver numbers?
I'm sorry?
Could you graph with like the original numbers?
Well, it's a better graph, but I don't like the allocation because it doesn't put anything. And Costco still looks expensive. I don't think it radically changes the companies, but you see the graph is tighter, right? So that,
would you take off or using that graph without changing the weight?
no, there's no right or wrong answer. If you're my R squared is all that great, it's only 58%. You know, so I think the great numbers. I'm sorry, Dave.
What is your thought process, putting a weight on change of asset turnover and not asset turnover?
Well, because asset turnover, these firms are so different. But I want firms that are improving their asset turnover. So there's different ways you can do it. I didn't do everything here. So one thing I was talking about here, I just brought in 2 years. I could have brought in 5 or 10 years and look at the median over time. That way, asset turnover will work well. Part of my concern is because of COVID. I think some of these numbers are grossly distorted because of COVID, because Walmart, Costco obviously did extremely well. And so it's going to make them look cheaper than they really are because their revenues are so high, which makes Costco look even more expensive. And so if you take 5 years or 10 years and take a median, that way you get something. I like to do the change because I like firms that are improving. You know, that's just kind of my bias. You could certainly bring in 5 years of ROE and take the average and median of that. I prefer median over average because some firms, they can get like a 20,000% or something, just get ridiculous numbers because 1 year, you know, the net worth got down to a really small number and gave you this massive return on equity. So there's a lot of things you can do here, no question. But if you're going to do those kind of things multiple years, put them off to the right and then do your ranking on a summary statistic. So you can see here, change in gross margin. I had 2 columns to do that. I did off on the right, so only need 1 column here. It keeps it nice and, all right.
Will you run your solver real quickly just so I can see what you're thinking?
I didn't have constraints, but I did try constraints where I put constraints on this and solver refused to let me do that.
Okay, that's what I
It
thought.
just was so irritated with me that I finally gave up. I was like, okay, Bill, I give up. So I went back to the manual. I don't mind the manual approach because these weights are what the market thinks is important. But ultimately, it's what you think is important. So you can put your own weights in there. The only thing is when you put your own weights in there, it is going to reduce your R squared. Obviously, it can't go higher. So I think my R squared was above 60 without that, and then it dropped down to 58 with it. Right. So there's a few ways you can handle this. So if you want my model, you have to email me. And then that means you're using my model and we're going to discuss my model. If you don't feel confident building a model, but you want the 10%, then set up time with me and we'll sit down and build a model right there. You still get the 10%. Much more time for me, but I will do that because I'd rather you learn this than just use my model. But if you build your own model, you know, that's the best. You teach yourself how to do it. You know, learn how to teach yourself and do the stuff across the YouTube. If you don't think you can learn it off of YouTube, not putting pressure on you, but we had a student that's not a finance major, an engineer major. He wanted to be a senior analyst. He asked me to teach him how to do it. So I walked in to teach him how to do it. He already had the entire model built just watching YouTube. So he didn't need me for anything. But okay, I would hire this kid in a second. He knows how to teach himself. He's not even a finance major. He's just doing this to expand his experience. He did it. He went for 1 year and then we never saw him again. I don't know where he is now. He's probably CEO of Costco. So that's the best. You teach yourself how to do it. But if you want me to teach you how to do it, you can still get the 10% and I'll let you build it, but I'll give you help you on how to get the sectors and bring things in and how to fix the chart. But if you just don't have time for all of that, then email me and I'll send you this model. I've already, for retail, I've already got a bunch of stocks built. All right. So this is one of 3 things you need to do on paper 7. So what are the other 2 things? We won't do them, but I want to show you one of them real quick. This other one's fairly straightforward. So I've got a model built for you here. And what we're going to do here, I used to have this already built with the graphs, but I was using this new function that I don't fully understand, and boy, it blows up. It's an output function. I never use the output function. But the reason you use the output function is it automatically adjusts for how many other lines you have. So it just looks to see if you have data. If you have data, it grows you, does your charts. So it's really nice because some firms can go back to 1990, some can only go back to 1995. So I said, forget that. I'm not going to do that. You got to build your own charts. So sorry, but anyway, what we're going to do is I have Walmart here, and I bring Walmart in. You're actually going to do it on the Bloomberg page. All you got to do is put your company's ticker here, and then put the ticker for your industry. I gave you some tickers for industries. All right, so you got your industry tickers. So what we're going to do, you bring in all your PE ratios, EV to sales, price to book, EV to EBITDA. You then paste value them over here. And then what you're going to do, so you're going to compare these. So we'll talk about this next class when we just give you one example. So here's Walmart's. This is PE ratio to consumer discretion, consumer staples. And here's Walmart to the S&P 500 relative. So what do we mean here? So here's the graph. You can see historically, the typical consumer staple is on the 1 line. So historically, Walmart has traded very expensive to its industry. A few years ago, they got cheap to their industry. Right now, they're right in line with their industry. So if we look historically, Walmart has traded 6% rich to the industry. Right now, they're 10% rich to the industry. But you can see there's periods of times where they're very expensive to their industry. Versus the S&P 500, historically, they've traded rich to the S&P 500. Right now, they're actually trading cheap to the S&P 500, which implies what? Consumer staples must be trading rich to the S&P, right? To make all this work together. So Walmart's trading cheap, trading expensive to consumer staples, but trading cheap to the overall S&P 500. Why? Probably because those tech stocks are really driving up the S&P. All right, so we'll talk about this. You got to build some charts. You'll see these in the example papers and discussion. This is probably the easiest part of the paper because you just discuss your firm. You don't have to do all the ratios though. If you look at the example papers, some students do every single ratio. I think it's overkill. Some students create their own charts and other things. I think it's overkill to do all of them so far. Walmart, I'd probably do the PE ratio and the EV to sales. You can see on EV to sales, they're trading cheap to their industry and very cheap to the S&P 500. Cheap versus what? Well, they typically trade very cheap to the S&P, but we're talking cheapness versus their history, all right? Historically, where have they traded versus where they traded now, all right? So we'll talk through that so you see how that works, but it's very easy to talk about, probably one of the easiest parts to do. So that gives us two of the three things. The third thing is the target PE at your terminal growth and doing that one. I'll show you how to do that in Walmart. So paper 7 can be one of the easier papers because once you get all the Excel done, it's just writing what you did, similar to what you did on the forecast model. All right, let's stop it there. I'll let you out a few minutes early so you can go build your model. All right, so Bond might have won the football field. Let's see if we can actually do it. So here's the football field. I wouldn't call it football field. I would call it valuation summary or valuation analysis. But what do you want? You want to show where the stock has been trading. I guess I'm not quite understanding this dotted line, but so I don't like this particular one. To me, the dotted line should be where the stock currently is. That would be my idea. But obviously, that's not the case here because it's not in the 52-week trading range. And in your valuations, I wouldn't do current analyst forecasts because you can if you want to. I don't know if that's all that valuable, but you'll have your different models. You can put it in paper 6R if you want to. You can wait and put it all in paper 7, and I just won't grade that part of paper 6 until you finish paper 7, because paper 7 you're going to get another set of valuations, and you're going to have to redo this whole chart anyway. All right, so let's see if Bond can do it. I'll give him 12 seconds.
Hopefully there's someone back up ready if I can. All right, so we've got a high and a low here, which is the important numbers. So we're going to get the difference between these. So we've got our high minus our low. Now, let's try. Insert. Oops. Okay. Going to go to bar, you go down here to 2D stacked bar chart. And all we're going to do is take out the left and right sides of these. So you just go to fill, no fill, over here again, no fill. And then we just want to add some numbers in. So to do that, you highlight these ones again. You go to our additions, data labels, data callouts. So we want numbers. That looks pretty good right there. We want inside the base, which will be closer to the columns. If we do inside the end, it's not going to look as good. So we just do inside base, which moves them and gives us those. And then same thing for the other side here. Except on this end, we want them inside the end. And then we can make the chart look a little bit nicer by fixing up our axes. We can change that from 500 to 400, it looks like. Even 300. And once we add our title, that's about it. We shouldn't need any series. And then our base number, which is that line kind of going through the middle that the professor had. If we look at our base case here, that 115.92.
I still think that's the price, but I guess it's up to you all. Because we have 3 base cases.
So, you know, that 115 is going to be like right in here. So we're going to want, you know, a marker in here. But it looks like there's going to be 4 different markers since there's 4 different base cases. But I think, you know, this should be sufficient for what we need in our graph.
It's not going to fulfill like the actual price. Does the actual price make more sense? You want to know where you are versus the price, so that makes more sense. I'm not sure base case is moving. Number of community. All right, wow, okay.
All right, let's save that. Don't use red though, you gotta use blue. And I guess, I mean, that's the other thing is can you vary the colors coming down? You actually can select one and change that color, right? So that shouldn't be that much of a problem. All right, good. All right, so if you remember for this paper, whatever it is now, 7, I guess we're up to. Just keep reminding you what we're after here. There's 3 parts to it. The first thing you're going to do is talk about the history. So we want to do that. We want to say, and the key for the history, we'll get into that, but it's where are they trading today versus where they have historically traded. So we're trying to size them up against their own history. And then you have the ranking model. There you have the choice of building your own or using the one I build, but if you're going to use one I build, you got to let me know because I've got to build it. And then you're going to do the valuation using dividends and a terminal EPS. So those are the 3 things you're going to do in this paper. This again is a lot of Excel work, and then your paper is summarizing what you did in Excel, which tends to be, you know, after you get past paper 2, that tends to be what we're doing the rest of the paper. We do it in Excel, except for paper 3, obviously I did all the Excel work for you, so it's just using the charts. So here what we want to look at is current versus history versus the market and peers. And the reason we say that is you don't want to just, and some students will do this, they'll just graph the relative. Oh, did I close down the wrong chart? Find the chart. I think I did. Coming up.
I think that's actually.
Oh, this is it. Okay, I just didn't recognize. Bro, I shouldn't name my charts Walmart because they all look the same. All right, so here's Walmart's PE ratio. You could quote do that, but what's the problem with that? Well, what's the market doing? We know when inflation's high, PE ratios are low, and inflation's low, PE ratios are high. This may have nothing to do with Walmart's richness or cheapness. The whole market may be doing that. So what do we want to do? We want to take Walmart's PE ratio and do a comparable. And the way you do that, and it's really pretty simple. And it's amazing how simple it is. You do the company PE divided by the market, the company PE divided by the peers. You just divide. So let's just look at some numbers. I mean, it's amazing that it's this simple, but it's just the way it's always been done. So today, Walmart's PE is 24.16. Consumer staples are 21.94. So if you're in an interview, how do you adjust for this? You just take the 24.16 divided by the 21.94. And how would you, anybody know how you would say that? So, okay, I've been looking at Walmart right now. They are, what would be the sentence? Yeah. Trading 10% rich to whom? To peers. This is it's industry, however you want to say it. Here we're doing consumer staples. You're trading rich to staples. Well, does that mean they're trading rich right now? Right now they're trading rich to staples, but the other thing is, what have they historically done? Historically, their average has been 23.81, and staples have been 19.99. So right, historically, they've traded 19%.
Sorry, what's the total? 94?
2194 is the peers, the industry. Today. All right. So today Walmart's trading 24.16, their peers are trading 21.94. So today they're 10% rich to their peers. Historically, do the average. Let me just read the average of it. So historically, they've traded 19% rich to their peers. So what does that mean about today? They're trading cheaper than they have historically. So we can actually say, whoa, Bill Gates, I don't know why you would think I want that. Today, Walmart is trading 9% cheap to its history. All right, so those are all true. So right now, Walmart's trading 10% rich to their peers, but historically they've traded 19% rich to their peers. So right now they're trading 9% cheap to their history. All right, y'all got all that? I want you to type all of that out. 10, 19, and 9. So today, Walmart is trading 10% rich to other staples, but historically traded 19% rich. So they are today 1% cheap. Why do we say that? Well, because Walmart might trade rich to the industry because they're less risk. They have lower betas. I mean, there may be perfect reasons why they trade rich to staples, but why are they cheaper today than they've been over their history? And just because they're a much bigger firm now, they can't grow as fast. I doubt it's because they're riskier today than they were. All right, any problems with this sentence? Y'all okay with that? That all makes sense? You're probably thinking it can't be that simple, but it really is simple. There's no Albert Einstein in this. It's just a quick way to gauge where are they today, where have they been historically, and so where are they today versus their history. And you can get it all in one sentence. Let's see if you really understand it, because I'm going to bring the S&P 500 over. Today, average, you can tell me. So today, S&P 500. $25.95. I never know when I have the pin key hit. So today Walmart's 24.16, the average. Average is what, 23? All right, so what do we do? So we need to do the relative to the market. So how do we calculate that? And then minus one. So historically, someone give me that sentence. Or today,
Walmart is trading 6.72% cheaper than.
cheap to the market. Historically, 18% rich. So they're actually 25% cheap for their history. That makes sense because you got all these tech stocks that are way up, right? So this is the S&P 500. So yeah, Walmart looks cheap today versus their history. You can actually graph that if you want to. So I have it over here. I have their PE ratio versus the S&P 500. So back in 1990, they were trading 60% more expensive than the S&P 500. Over time, they're now cheaper. You can see how the valuation is coming down. So they're at a pretty relatively cheap area, which, because of what growth stocks have done, somewhat makes some sense. They would be trading that cheap. So the only thing that you have to do is build your own charts. So you've got everything there. I used to have it so it built the charts for you, but it's just, I don't trust that format. I don't understand it anymore. And I don't have to watch a YouTube to figure it out. So you'll just have to build your own charts. But y'all know how to do that, right? That's pretty simple. You just put it in there. Some students like to do this. It can work. So you've got your company versus the peers and your company versus the market. You just have to look at it and see if it works. This one works okay. So the orange is versus Staples, the blue is versus another. Orange is the S&P 500, the blue is Staples. Very similar kind of line going there. So this is more Walmart. It's not like Walmart's gotten cheap, but the Staples have gotten expensive. This isn't a Walmart specific thing. This looks like this is more of a Staples thing, doesn't it? Walmart's, well, maybe I'm not saying that right. So this looks like this might actually be more of a Walmart thing, but they're moving again. I wish I could find one that was really crazy because some of your stocks are going to be really crazy. So what do you do when you have a stock? And some of you are going to have this where you have a stock doing that. So when you have that kind of graph, do you put that graph in your paper?
No.
Absolutely not. All right. Some students do. It's like, well, that's the numbers. But that graph doesn't tell you anything. What's going on here? Well, you got a firm who earned 2 cents per share because they had a really bad year. And so their price earnings is like 47,000 or something. It's just a nonsensical number. So what do? You get rid of those. And make sure you get rid of the part of the graph too. You just get rid of those points. And one thing to remember, those points can be right in the middle. Same thing. If they're right in the middle, just get rid of those. All right, take them out because it doesn't make sense. You don't. They're just, for special cases. They usually don't go on too long. Usually a firm might have 1 year or so of really, really low earnings. And really what's happening is if their earnings is negative, you don't get a PE ratio. And I've fixed that in here because what it's doing on the output is it's actually lining up the PE ratio. So if your firm's missing 3 or 4 weeks, I'm doing a vertical lookup and I'm lining up the weeks. So it's going to line up correctly. But you can still get points where even though you get a PE, you don't want to show it because they could have had a 5 cent loss but they just barely had a 1 cent gain. If they had a 5 cent loss, those weeks just wouldn't have shown up. Or those months just wouldn't have shown up and everything would have been fine. But instead they made 1 penny and now their PE ratio is just off the charts. So now I do it several different ways here. So you want to create your own graphs. What do you do when the graphs look radically different? So you saw that one, and then we're going to do it on EV to sales. You can get radically different looking charts. That's a pretty significantly different looking chart than what we saw before, isn't it? So what does that mean? Well, for Walmart, EV to sales is the most logical one to use. And obviously they're going to look cheap on EV to sales because they have massive, massive sales, but that's true of all staples. So if they're not telling the same story, you can look at some of the student examples. You've got to find some way to explain why they may look strong on one versus the other. Part of it can be what's going on in the S&P 500 and what's driving that. You obviously got to put some dates in here. I gave you EV to sales. I gave you price to book, which is probably going to give you an even more radical looking chart because of the tech stocks. They've always been cheap on a price to book basis. This chart looks even more different. And then the last one I gave you is EV to EBITDA, which should look similar to the PE ratio. So it looks almost the same. So you got 4 charts that I gave you. If you want to create your own, come talk to me and I'll help you get those in there. There's some you can't do with the S&P 500. So like Javier wants to do EV to regulatory assets. You can't do that for the S&P 500. So there's some ratios that you can't do. But now you'll see some of the papers do all 4 of these. So one trick you can do, I want you to show at least 2 of them. One trick you can do, if you got 2 or 3 to look really good and one that's really squirrely, guess what you can do? Just leave the squirrely one out, all right? So you can prevent yourself from having to explain things you can't explain. But do the one that's the most obvious for you. So if you're doing tech, you would definitely want to do EV to EBITDA. This is the most common. If you're doing retail, you want to do EV to sales. You probably want to do PE ratio for all of them, but again, as you can see, PE ratio and EV to EBITDA, they look exactly the same. There's no reason to show them both. I would not use price to book for technology. That would just be kind of bizarre. But you'll notice the student example papers, some of them do all 4 of them and talk all 4 of them. What you're going to discover when you read that, it gets really kind of boring. And then you get these really great creative writings where they're trying to explain, well, they look cheap here, they look expensive here. And now you got a challenge to try to figure out why that's the case. All right, so pick at least 2 of them. You'll probably be picking PE ratio and EV to sales or PE ratio and price to book. For tech, I might do EV to sales and EV to EBITDA. Pick 2 that makes sense and show them. Let me show you some student examples so you can see some of what I mean. It's really fairly easy part of the exam or the paper, and most students get full credit or close to full credit because it's really not that incredible. Should I show you Microsoft again? It's somewhere around page 387, I think you do. There's his model. That's really cool, actually. He showed all the factors in his model and had this really good way of showing it. Right, so.
Where is this student?
He's a graduate student at UTSA now. All right, so you can see how he did. That's the other approach. Instead of doing the relative, you do your company's PE and the markets. That's 2 lines instead of 1. I prefer to just show 1 line. All right, but he's showing both lines. And then he's showing the range on the other end. I'm going to show you a different one because this is, he's getting a little too fancy. Let me show NVIDIA. This was just a couple years ago, so not too far off. There's his model. You can see he didn't have the greatest model of all the R squared. I don't know what it is. I don't know if he even gave the R squared. There's his company right there. Obviously, NVIDIA is a very expensive company, but it's also a great company. So he's just saying, hey, it's a great company, but it's expensive. It's right where it should be. Right, so he did it. He did NVIDIA and then he graphed the S&P. So he could have gotten this to one line, but he used 2 lines. All right, so what all did he show? He probably showed all 4 of them. So price to earnings, he shows S&P and shows NVIDIA. He might have done this mainly because the relative was so volatile, because NVIDIA was so volatile. So he might have found the graph just looked a lot better if he did it like that. But the nice thing here is you can say they traditionally try pretty expensive. And then he was writing his paper when this happened. He had like this 40% drop. So his stock went from expensive to well valued while he's writing the paper. I think between papers 6 and 7, he had that happen. So again, there he is versus the S&P. No, this is versus the index, right? So you can see the financial crisis jumping in there. And here's the other advantage is when you show both PEs, financial crisis, COVID, if you're doing one relative to the other, you don't get huge swings on firms like a Walmart because they're kind of moving together. Here they still look pretty expensive. That's EV, the sales. So yeah, he showed EV to sales, PE ratio. Yeah, he just did a couple of them, so that works. All right, so I still haven't seen one that's actually doing my charts. So I guess they didn't care for my charts. Adobe, okay. Oh, this one has a really good executive summary. They're not good. They did a good job of really making it look sell side research. Very, very well done. The paragraph's a little bit long, so I would have broken that up some, but the coloration and the tri columns is a really good way to do it. All right, so Adobe PE relative to the sector, Adobe EV EBITDA relative to the industry is rich. He might have done a line which was just their average over the time, so you can see where they are versus their history, versus the S&P, EV EBITDA versus the S&P. So this is not a difficult part to write other than picking the charts and getting them cleaned up and prettied up. So that's difficult. And there's his model. He had a really good model, isn't it? That's a pretty tight model there. And again, his firm's right on. All right, so it's fairly straightforward, not a difficult part. The main thing is that you try to make, this sounds really cool if you're talking to non-finance people. Says, yeah, Walmart's trading cheap to its history, especially if you're trying to impress people. It's like, yeah, they're 10% rich to their industry, but that's still 9% cheap to their history. And that just sounds, you sound like a finance person, right? It's like someone on Wall Street. It sounds pretty cool. So they can be rich to the market. They can be rich to their history. Those are the kind of things that make some sense. All right. We did the ranking models. So we know the answer there, what you're going to do, and you can see that from the papers. So most of that work is simply getting the model and then just interpreting it. Do think about how you list your factors. I did like that a lot in that one paper we saw. Did a good job with just what factors are important in your model. If, let's say you had 20 factors and the model only allocated something to 7 of them, you might emphasize the 7 it allocated to, but then you might also talk about the ones it didn't allocate to and what you find interesting about that. Or you can do like I did, is it didn't allocate anything to it, but I went ahead and added 5% anyway because I thought it was important. That's what I did on the Costco one or the Walmart one. So you can just also do that, but have some sense of, so the person knows what did you consider, what's in your model. Should you give the R squared? I find it interesting. It's pretty obvious from the chart. You can tell when you have a 0.9 R squared and you have a 0.2 R squared. Jabari's not here, but his first model, I mean, there's just dots everywhere. R squared, I think it was like negative 0.1 or something. Our correlation to negative 0.1. So you might give the R squared, if that makes sense. And again, you talk cheap or rich. Here you're talking in terms of ranking. So where do they rank in your model? Where do they rank in valuation, and how far away is that? You could do a discussion. I haven't seen many students do this, but I find it interesting is, okay, they ranked 7th overall. And here's the 5 factors my model is using. They were weak on 2 of them, but man, they were really strong on that 4th one. So boy, those gross margins, if it wasn't for gross margins, they wouldn't have ranked so high. And how do you figure that out? We'll just go up and put a 0 on gross margin and see how their ranking changes. And you'll know right away, man, gross margin was the key to their ranking. Y'all remember Monsanto reading that thing, Bond, with Monsanto? We did Monsanto last year, but it came on our buy list and we're looking at it, and we looked at the model. The main thing that put them high ranked was their sales growth. But the only reason their sales growth was so high is because they bought another firm and they parted the firm. So their sales jumped 20 billion all in 1 year. And that wasn't organic, that was buying. It was like, well, the only thing they really do well on is somewhat artificial. So maybe this isn't such a good company after all. So that's why looking through and seeing what is it about your firm that really got it to where it ranks high or low, that can be valuable in your analysis of the company. Let's even look. Adobe looks pretty strong here. Let's see what he said. I don't even remember who did Adobe. When you run the model, we get an R squared of 87 with correlation of 0.93. I don't think you need to get both numbers because they're essentially the same. The relative value model is given by Professor Sui. Okay, so that's fine. I don't give you extra points for putting my name into your paper. The model weighted the most importance on, so he did a good job here. He's actually talking about them. 3-year sales growth, gross margins, EBITDA margins. What could he have done that might have been a little better here? Maybe a table or chart of some kind, right? If you can put it into a quick table, I think that's better. Margins are obviously the most important to the technology industry along with short-term growth. It shows the company ratings on the trend line where they are equally valued by the market and the Excel solver metrics. All firms below line are rich. Adobe is almost perfectly on the trend line, slightly to the rich side, but fairly valued. So he just says they're value. And then he talks about a peer. Salesforce is ranked 14th and 17th by the market, making it fall right on the trend line. This gives me the confidence, the accuracy of relative value metrics. I mean, that's a very, very strong model. Now, we know how we cheat a little bit is, you kick all the outliers out, and then, all the dots that were over here and all the dots that were here, you just magically they disappear. But that's fine. It's like, well, those companies don't really fit in my industry. As I look at those 100 companies real quickly, they're in a different business. Your college students, you get away with some stuff you can't get away with in real life. That's fine. Is anyone you're interviewing a job with is going to know that you did that? No, so you get to cheat a little bit in college. It's like my composition professor. We had to write a piece of music like every 2 weeks. And he said, I don't care how horrible it is. There's no such thing as a writer's block. And he said, and it doesn't really matter anything because anything you write in college, 5 years later, you're going to think it's disgusting. So just put it down and go with it and learn. So, okay, fine. I actually still like my composition. All right. So didn't take much of his paper, did it? And he probably got pretty close to full value on that. So he talked what he needed to. Is it in there? One thing I've never seen yet in our CFA Research Challenge, none of the teams have done this. I've never seen any team do it. I don't know how this would work in the CFA research challenge. I actually think it might be pretty interesting to the judges to do that, but no one's ever tried it. So maybe the next team will. We'll see. It'd be interesting. Let's try one more paper because I do think this section especially gives you some. Well, Coca-Cola, one of my favorites. This is a little bit older, so it might not. Every component we're talking here. He used the data table, very good looking. Now, you notice one thing in his paper, which I think makes a lot of sense, is he's got it color coordinated throughout. Why is that important? But because the first person you're going to talk to is the human resources person. What do they care about? Got to be pretty, and you know, so do think about things like that. It does make a difference. Okay, relative value. So he did it the other approach. He put their PE ratio, the industry, and the S&P 500. Coke has consistently traded a premium to its industry and the market. EV to sales. Here it's interesting what I did Coke versus Pepsi. You could certainly do that. You'd have to run the model twice. I don't have it set up for good companies. You have to run the models twice, save it, and then collect the data together if you want to do that. So if you're doing Home Depot and Lowe's, then yeah, that would be a really good chart to do. So you can do it against the industry or a key peer. That makes a lot of sense. Does it make sense that Coke is trading rich to Pepsi? Back in 2000, whatever, 17, you know, it'd be interesting to see the day if that's still the case. Here's he's got, he did price to cash flow. I don't have price to cash flow. So y'all tell me, is price to cash flow correct or is it EV to cash flow? I think we talked about that last class, which is correct. So what do you have to ask? What's the only thing you hear about? Interest expense, right? Is CFO net of interest expense or gross of interest expense? It's net, incorrectly it's net. So you would use price to CFO. So that's what he did. He did the right thing. He didn't lose any points there. Got some good titles. This works. I mean, that font is not too small and he's getting everything into his title. So I don't know if he shrunk that down. It doesn't tell me. What's that, about 9 maybe or 8? But I can read it. It's perfect. If I can read it, it works well. So that works well. Very professionally done. That's why I told you early in the semester, think a lot about formatting when you start, because you don't have to go back and fix everything for when you put this on LinkedIn. Then he finished up with, I guess that's the last one. So how many did he do? Price to EV to EBITDA, EV to sell. EV to sales probably makes the most sense. And then price to cash flow. Those are the ones that he did. I don't know why he called this PE, but here's this regression model. Not a very good regression model, but I don't know why he included it in there. It doesn't look like all consumer staples. So he must have brought it down. It looks like it's more than just the drink peoples. Could you include soda and soft and hard beverages in the same one? I don't know. That seems kind of strange, but I guess it's possible. But there's Coca-Cola right there. Now what's really missing here? The cheap and the rich, right? You got to make sure that's somewhere in your model. All right. So not a difficult paper, right? I kept telling you they get easier as you go. If you got a good model, it's not. And I've already done the Excel work for you on that one. And that Excel model I was showing you is out there in the class models and templates. Oh, maybe I haven't put it out there yet. I thought I had. Okay, I'll put it out there. Boy, I hope I don't forget. Is this? No, that's not it. No, I guess I didn't put it out there. If I did, I put it in the wrong spot. All right. Wow, I gotta Someone emailed me to remind me to do that. Boy, I could have sworn I put it out there. Maybe, let me put it out there right now while we're talking about it. So I'm gonna put it on the models and templates. What do y'all want me to call it? The relative value Excel file. And what's it called? WNT relatives. That's valuation, though, right? WNT. Oh, I'm in the wrong. WNT. If y'all see it, stop me. WNT. No graphs. I think that's it. We'll see. I probably can't open it right because I already got it open. So you open it. Let's see what it opens to. I probably should have checked that. Yeah, I'll have to fix it. So you want to come in. This page is just going to give you errors. The paste page, you probably want to come into this page. So I'll save it so you come into the output page. There's your sector ticker. So if you need another sector besides Staples, you just pick your sector. If I'm missing a sector, I think I got all of y'all. If you're not sure where it goes, Disney and Netflix go in S5 tells, which seems really strange, doesn't it? Because they're not in telecom, but that's the ticker for communication services. There's consumer discretionary, that includes Amazon. Amazon used to be a tech stock. Staples includes Cisco and Tyson. There's your energy, healthcare. Oh, yeah, there's a few doing healthcare. Industrials, that includes 3M. 3M is considered an industrial, includes Schneider Electric. Information tech. Information tech includes Visa. That's kind of strange, isn't it? So that's actually pretty good because you really wouldn't want to do Visa against banks anyway. Materials, that's where they have Ecolab as a chemical company, real estate, and then utilities includes Exxon. Right, so I think I got everybody. I looked through all of your stocks and I think I got everybody. I don't know what this even means. Oh, this is Walmart's. Yeah, you could use this one if you wanted to for your company. What this does is it brings in EBITDA, earnings per share, and revenue. That's for that growth. Remember, I did that here to show their growth over time. So if you wanted to do that, show the growth rates over time, you can certainly do that with this one here. So that one's, I'll just leave that in there. That's not hurting anything. The only problem is you need to come in on this page. So I'll resave it. But anyway, so you have everything you need for the first two, unless you have questions. Does that make sense? I can handle that. I think some students are like paper four, and it's like nothing's sinking in whatsoever. But you got to be able to handle multiple things at once sometimes. All right, this last one, what we're going to do, you're going to use your forecast, which means you don't want to do this part until you've gotten a decent grade on paper 4. If you got a 0 on paper 4, then don't start this part of the paper 7. So use your forecast out to terminal growth, which means you may have to add a few more years. So if your firm's still growing 25% 5 years out, you're going to have to go out further than that and bring them back down to more normal. You're going to discount dividends and terminal stock price. And then your terminal stock price is going to equal terminal earnings per share times target PEs. So that's the approach. He took Nicholas's society class. He was going through this approach. He found some Excel from an investment banker's website, and it did everything we're doing with one exception. It used free cash flow instead of dividends. I'm using dividends instead of free cash flow. But that's only because we didn't really forecast free cash flow in the forecast, so you don't have it. That is a more typical approach, is use free cash flow. He also discounted it at the WACC. So just to let you know, I'm supposed to do this in this class, but I don't want to mess with the WACC. But just so you know, if you do investment banking, this is their approach with two exceptions. Their discount rate is not what you're doing in paper 4 or 5. It's not paper 5. The discount rate's actually the WACC. And you don't use dividends, you use free cash flow. But other than that, we're doing it essentially in that same model. And then your terminal PE is going to equal ultimate payout rate expected divided by long-term risk-free rate plus long-term beta times market risk premium minus. Remember that formula from last week. So the firm's payout might be 20, and that's really how you know they've gotten the terminal, is when they're paying a normal PE, normal payout. I would say a normal payout is somewhere at 40 to 50% of earnings. That's pretty typical for us, for most companies, is to pay about half of their earnings. So when your firm gets to a 50% payout ratio, so that means you might have to adjust that in your model.
How do you determine how
You make it up. You've got to figure that out based on what you know about your company. Okay, it's pretty tough. You know, in paper 5, you're going to somewhat do that right with the H model. But what you need to do, this is pretty important, is, you know, link papers 5 and 6. If I got them right, or is it 6 and 7? Sorry, 6 and 7. So if your H is 4 in paper 5, then where's your terminal growth going to be? It'd be your H, right? So be somewhat consistent there, which means if you have high growth rates and your H is 4, you better see those slowly coming down over time to hitting your long-term terminal growth when you hit that 8th year, right? So you're consistent between the two. But how do you get this 4 or this 8? Yeah, that's just, what do you think? It's a forecast. It's probably the hardest thing for students to come up with, because there's no place you can go to get that number. I gave you a little bit of that with what we did with the Walmart file. Now, it's possible these type of charts might help you. You know, if your firm is still going up, then you just assume the typical, just give it a nice looking shape to it and say, hey, you know, they're still growing, but eventually you're going to come back down. You know, we're talking in my investment class today, we're talking about DoorDash. I thought Jabari's numbers were a little interesting. He said they had 20 million consumers. It's a pretty small number in a world of 7 billion. And they have 1 million delivery people. That doesn't make sense to me. So I'm just thinking the math. If 20 million people order DoorDash once a week, that's 20 orders a week per delivery person. They make, he was saying they're making $30 an hour, but even $30 an hour, if you only have 20 deliveries, you're not making much money. So that doesn't make sense to me. So there's something wrong I'm missing unless that 20 million is ordering something every single day, which I don't think is probably true.
Maybe some of the delivery drivers only do it a couple hours a week.
Yeah, once a month or something, yeah. So that didn't quite make sense to me, but I bought my first DoorDash gift card. Have two friends that are having medical issues, so I thought, hey, they can go out and order food and not have to worry about it. Why did I pick DoorDash instead of Uber Eats? I just looked at the websites, and DoorDash just looked a lot easier, a lot friendlier, and a lot of restaurants. And it's kind of this platform effect, right? They got 300,000, it's almost like MasterCard versus Visa. How many restaurants do they have? My friends are in Houston, so I looked how many they have in Houston, those kind of things. They're doing exactly what you want a firm to do. There's two things a firm does. They either solve a problem that's frustrating people or they give people status. So what is DoorDash doing? Solving a problem, right? You don't like, hey, I've got DoorDash outside. That's probably not what you're doing, but it's solving a problem. Pretty good problem, right? We're all time constrained. We're willing to have someone else bring us some stuff. So could you get that up to 100 million, 200 million people? Could certainly see that. So Facebook went from what, 1,000 Stanford students to 3 billion customers in a pretty short period of time. Could DoorDash be that kind of company? And if they are, could they do it without other people coming along? Uber and Lyft are kind of oligopoly. So you think through those kind of things, and then you have to ask those questions about China and India. That's a huge question. And you have to make those kind of decisions. All of that would be in your discussion, definitely. It might be more in your paper 5 than in paper 6. In paper 6, you're just pulling that forward. But that's what you're trying to do, figure out those firms. And it's not easy to do because you're trying to predict the future. But it seems like a pretty exciting firm. Obviously, this isn't DoorDash. You notice Walmart. This looks like a firm at its terminal growth, doesn't it? And it's there. So what else can I do with Walmart? There's not much more you can add to it. It's kind of there already. All right, so let's look at Walmart real quickly, and we'll try this. This is one I don't grade it all that harshly. The other professors, this is like supposed to be the focus of this class, and the other stuff is pretty critically important. And just because I hate having to do WAC, I'm kind of away from that. So let me bring up the Walmart, the other Walmart. I should stop calling them. It's not it. It's the other Walmart. Not that one. That one. I think it's the one that starts with the letters. Numbers. 3. I think it's that one right there. This one might work too. I'll try it. That's the one I just had up. So yeah, this I think this one. All right, so here's my forecast for Walmart. Let me crazy it up a little bit. All right, the revenues are growing 8.5%. Have we hit terminal growth yet? Probably not. Maybe right there. And we'll go down to the payout ratio. So my payout ratio gets to about 40–50%. My growth rate gets to a normal growth rate. My earnings per share, let me just double check. It's growing at a pretty normal rate, right? 4%. That looks pretty good. right at 4%. So everything was good. My graphs are probably not gonna be too good. Would Walmart like something like that? Wow, we just took over Amazon. Great gross margins going up. Great earnings growth. Great asset turnover. Great ROE. Everything's looking great. It doesn't look ridiculous other than the revenue growth. It looks good. So let's forecast this company. So my discount rate today and terminal. So my day discount rate is free rate. Market risk premium data. So this comes right out of your paper or whatever it was. The ultimate payout is 50%. Wow, I don't know how Bill Gates knew that was going to be 50%. Target PE. So y'all remember the formula? Payout. I gotta get my terminal growth. What was my terminal growth? 4%. Payout divided by risk-free rate. Market risk premium. Beta. Obviously, I could have just done the KE. My ultimate payout, my ultimate PE rate was 16.3. That seems reasonable, doesn't it? If interest rates are 3.5%, PE ratios would be much lower. That makes a lot of sense. And then all you got to do is just forecast it out. Dividends, earnings per share, 2022. My dividends. Dividends per share are line 94. Earnings per share, y'all stop me if I'm doing something I'm not sure what I'm doing. So earnings per share is $6.20. Now they really need a button right there, don't they? A white button. Does anyone create that? All right, and then present value. So the present value of 62 is going to be 62 cents divided by 1 plus my discount rate. Raised to time. Are you good with that? So why do I do B11 minus B20 minus 2021? The first power, second power, third power, right, all the way across. All right. And then the terminal value. It's going to be the $11.84 times my target PE, right? Here's my target PE. Seems low, doesn't it? But remember, my valuations are like $90, $100 versus the 175. All right. So what I actually like to do is just the last year, I like to just take the dividend plus the terminal, put it all in one cell. So there's the present value of that. So what's the value values, just the sum of those. I get 132.05. All right. So let's look at it again. You got a discount. I know there's a big confusion here. Why do we have two different discount rates? This is the way I like to do it. We're going to stick with this discount rate. However, when they become a normal company, their discount rate's going to be slightly different. But I'm only going to use the 635. If you want a big theoretical discussion on that, that's fine. So 635, but I think eventually their discount rate's going to be 710. Their terminal growth is going to be right at 4%. Their terminal payout's going to be 50%. Their target PE, again, I just take the payout divided by essentially KE minus growth, right? Essentially, that's all there is. And the only reason I break out the pieces is I want to just show that PE ratios are sensitive to interest rates, sensitive to risk factors. I pull my dividends from my forecast. I go out as far as I need to go until I get the terminal growth. I don't need all these EPSs, right? So if that's confusing, you only need one. You just need that very terminal last EPS. Take the present value of those using that one discount rate. I'll never use this 7.10. Get the present value and then the value of the stock. So some of those, all right? I don't like this approach, and neither is Darren. Why doesn't Darren like it? Say again? Well, my assumptions are moving around. If you're talking about the assumptions on discount rate and those kind of things.
Because wax are different over time.
Well, you could definitely, and that, you could do that. There are people who actually use a different whack over time. That means a little strange, but you could do that. But let me show you what really bugs me about this. Let's take that dividend out. So there's a valuation. Here's the terminal valuation. %88 of their value is the terminal stock price in today's terms, which means, why does Darren say this is not a discounted cash flow? Because 88% of it is a relative value analysis. So this is his whole discussion. He has a really good YouTube he does on this. So he asked his students, how many of you are using discounted cash flows? How many will use them? And 100% says, yeah, we're definitely going to do that. And so that's what he taught. And then he decided to ask his former students. He asked, how many use discounted cash flows? And they said, yeah, we do, we use it. And he discovered they weren't, they were doing this. He said, that's not discounted cash flow, that's relative value analysis. That you make yourself feel better because you do some discounted cash flows, but it's not. This is a relative value analysis. And he said, now I don't believe his numbers on this, but he said 0% of students were doing discounted cash flows. I just can't believe that because we did discounted cash flows all the time at USA. So I don't know, maybe it's just New York Stern just doesn't, they're all working for investment bankers, which is just the investment banker approach. But this whole valuation hinges on what? Getting that 1613 right. Everything's loaded in that one number. And what is that one number? Well, it's payouts, it's interest rates, it's market risk premiums, it's the growth, the terminal growth of the firm. 88% of your valuations in that one number. So that's why he doesn't like it. I kind of see that as well. But why do we do that? Well, because some reason finance is real comfortable saying Walmart's PE should be 17. They feel more comfortable about that than saying, I'm going to forecast Walmart for the next 50 years. Even though this PE has all of that stuff you need for valuation, but it just stuffs it all in one number. Why in finance do we think we can calculate one number much more accurately than we can calculate the 50 numbers you need to calculate that one number? But for some reason, our gut tells us we know what a PE of a firm should be, but we don't know what the growth rate is going to be. Well, how do you know the PE ratio if you don't know all that other stuff? And it's just, we think we have this intuition of what a PE ratio would be based on what? Well, probably based on this, right? based on history. We're used to Walmart's PE being a certain thing, so we're kind of just used to seeing Walmart having a 2022 PE or whatever. So he doesn't like it much, but he started teaching it, and mainly because you see it so much in investment banking. So you do want to have something like this in your paper. You probably want it in your paper, not just give the results. You want to somehow put this in your paper so you can see it visually. So you're seeing dividends forecast and the terminal value and the present value of that, because that's what the typical, you might even look up some investment bank pitch books just to see how exactly they present this. If I can find some, I'll show them to you. But there's my valuation. So you need this valuation in your paper. There's only one there, but if you want to do 3 scenarios on that one, you certainly could do that as well. I don't know what you would vary in doing that. There's so many things you could vary on that with 3 scenarios, but you know, that is an approach. So that's the third one. I'm not real picky on it, so just do your best, come up with something that looks reasonable and put it in your paper just so you can say you did it. Because I'm not a big fan of this approach. So we can say we did it, and I can check the box that, oh yes, we did that. All right. Any questions on any of that? You got your paper 7 now. All we got left is 8 and 9, which this is the time of the semester. I want to talk some career and some portfolio strategy kind of stuff. So it gives a little time to talk stuff that's not in the paper. And so I might cover technical analysis. We'll see how it goes. All right, so y'all should be ready to go. So who all wants to meet with me next week? Who's kind of getting to that spot? Yeah, to talk about papers and go over corrections and those kind of things. Is it the whole class or is it just 1 or 2 of you? It's like it's just
Should we do it after the 7 papers or after 6?
It's up to you. Some students didn't get anything on paper 4, so they probably should meet with me. And some people didn't get anything on paper 3. I would say if you have nothing on 3 and 4 and you're not sure why, I would definitely get that out of the way, because you don't want to let the semester get too far away, especially on 3, because on 3 you may have to go back and watch all the videos again, and that could take a couple hours just to watch the videos. So I would say let's focus on those that are really struggling on 3 and 4. But if you want to get ahead, or if you have questions about 5 and 6, maybe 7's a little too early now. You have to go back and watch this video and last week's video for 7, but we're getting there. Okay. If we have extra time, we'll see. I'm going to scope it out. There's, I do want to show you some pitch books. I think that's really critical, and that usually takes me an entire class. I do want to talk about careers. So I'll look and see if we have extra time. We might just have a work class where we come here and just work on the papers. We'll see. So I'll play it by ear. So, all right, that's it for me.